we'll move right on. Lydia has given this session, at least at the iHub, once or twice, and it was so popular that she was meant to be here for, I think it was 2 hours. She ended up being here for 4 hours. So today we are attempting the impossible. We are trying to shrink down her 2-hour session into like 45 minutes. So we're just going to like really run through it, but again, just make the most use out of the Q&A session. Note down your questions. Thanks to everyone who responded to the questionnaire and kind of gave her an idea what she should cover today. That's what she's going to concentrate on, and then let's see how it goes. So Lydia, karibu.
Thank you very much, Nekesa. So I'm Lydia Ndirangu. I've been doing taxes for the last this will be my 9th year. And how I landed into the tax profession, I did law, but at the same time when I was doing law, I did accounting. So by the time I was entering campus, I thought I'd do BCom, but I ended up doing law. So by the time I was graduating, I had done my accounting, finished, and also I was also a lawyer. So I needed a balance of the two, where I get to still see the numbers that I enjoy, but also still practice law. And that's how I landed into the tax profession, and I totally enjoy it and I love it. So what we're going to cover today is looking at the basics in terms of taxes. It's not that at the end of this session, I'll make you expert and you can also open your farm, no. It's so that you just learn, get something, know what you do right and what you need to go change also from a different angle. And when you look at taxes, people say they're complicated. It's not easy to understand how they are being done. The law is everywhere. What do we do? Or am I doing the right thing when you're starting out? So we're going to look at the basics. And for the questions, as we said, note them down. But if there's one that's really, really burning and you still have to ask, you can ask it. And Nekesa, when I reach 45 minutes, please sweep me off the podium. So the thing we are going to cover today, for the outline, we'll just look at the basics for business structures in terms of which structures are there, because what happens with taxation, how you've structured your entity also follows how you're going to be taxed. If you're an individual and you're doing business, you'll be taxed in that manner. If you're a partnership, you'll be taxed based on that manner. So we're going to look at the business structures. Then we'll also look at the taxpayers' rights and obligation. We are seated here, and one thing you forget, we also have rights as taxpayers. We are citizens here, and we pay our taxes, so we do have rights. We have things that we need to demand for. And also, when you're given a right, there's also exactly, there's an obligation. And to whom much is given, much is? Thank you. And then we look at the registration requirements, what you need to register. And then just an overview of the Kenyan tax system. Then there's one interesting thing that we'll do. Common mistakes that we do, which you may think that, oh my goodness, I'm the only one who does this wrong, but you'll be surprised. We can be seated in this room, but all of us are making the same mistakes. And we're here to learn from each other. And that's why you've been told to actually network. You may have somebody seated next to you who've gone through the same issue you have, and they have a way out, yeah? So make sure we network. And then key takeaways. In terms of the structures in Kenya, we have the normal sole proprietorship. This is where you're on your own, you've decided to do business, and you register a business name. So for that one, you'll be taken as a sole proprietorship. Then there's for partnership, and now we have limited liability partners. And for partnership, what happens is that the different partners, you'll be taxed on the separate levels when you take your drawings. Then there's the company, and for companies, what we have is that we have normal company by shares, and we have the other companies limited by guarantee. But at the end of it, for companies, you're still taxed as a company basis. And then there's the non-for-profit or the NGO organization. These are the common entities that people normally form when they're doing businesses in Kenya. When it comes to your rights and obligation, the first one, information. And this is what everybody is seeking, this information, where do we get it? And the right as you have for you as a tax resident and a person who pays taxes in Kenya, you have the right to actually walking into the Revenue Authority office and asking for information, asking them, I am doing business in this way, I need to find out where can I get this information, where can I go and be assisted in this line. So it is your right to actually go and get the information. The other thing is the right of identification. And this one is more of when a revenue authority comes to your premises, you just don't open the door just because they've said they're KRA. It is your right to actually ask them, produce some documentation, or tell me who are you and what are you coming to do in my premises. And also when it comes to identification, it also goes in the sense that when they come to your premises, they must give you ample notice, in the sense that they send you a letter and tell you, we will be coming to your premises to actually do a particular inquiry or do a particular audit. So they just don't show up on your door and say, we are coming here to just gather information for you. But you'll find that certain rights, they get affected by what you do. If you've been doing business illegally and they think that you're one person who has been defrauding the government, that time they will just come and seize all your documentation, everything from your premises. So at that particular point, you can't tell them I have this right, but at that time they will have come with, they would have tried to contact you, tried to be civil, but when all fails, we go and become crude people, yeah? Then there's the other thing of pay the right amount of tax. And the key thing there is right amount, not more, not less. So it is you to pay the right taxes at all times. Then you'll also be presumed to be honest, unless otherwise. So whatever information or documentation you give the Revenue Authority, they need to take it at face value, not look at you and think this person is not a straight person. So what will happen is that they'll presume you to be always be honest, what you tell them is correct, it's true, unless otherwise. Then the other thing is the right to object and appeal. So this normally happens when you've gone into an audit process, they've inquired about your business, and they've given you a tax demand. So when they give you a tax demand, it does not end there. It doesn't mean just because you've been given a tax demand, you go right ahead and pay. No. You have a right to object and appeal the decision of the taxman. Unlike Tanzania, in Tanzania what happens is interesting. In Tanzania, the minute you're given a demand, before we start talking, you pay a percentage. So even if you've cosered a taxman, they can just give you something. You pay first. And you know when you pay money to the taxman, does it come back easily? Yeah, exactly. So in Kenya, the beauty, you do not have to pay taxes immediately you receive a demand. What happens is that you have the right of appeal and to object whatever demand. You'll only end up paying when the dispute has ended. The other thing is for privacy and confidentiality. She has talked about the whole thing of protecting your business interest. So the Revenue Authority also, they are obligated in the sense that whatever information you give them about your business, they are not supposed to go and disclose it everywhere. If you give them your trade secret or how you do business, they are not supposed to take it outside. If at any event you give them information and then later they publish it in the newspaper, you can actually sue them because for them, they're obligated to keep all the information you give them confidential. And the one to ask questions, we've already discussed it. So, in terms of obligations, the first one, registration. How many have registered for, you have a PIN, whatever business you're doing, you've registered for tax. That's number one, your number one obligation, registration. But we look at it, have you registered for the right obligation? You just don't go and register everything. You register for the right obligation. Then the other one is for you to file correct returns and pay taxes on time. That's another obligation you have. There's no discussion after you've registered and you do not file issues. So if you have registered, the next obligation is to file your return and to pay your taxes. And then the other obligation is you have to provide accurate information and documentation. Because remember, you have a right, you've been assumed to be honest. So they take it that whatever information you're actually giving, is accurate, and the documentation is also in order. The other one is to keep records, and this is where many of us are weak in these areas, to keep records. Somebody comes and asks you for documentation that you had in 2014. You have no clue. Yeah? So you have an obligation to keep records. And what happens is that the Revenue Authority can go back 5 years to do an audit. So if you started your business, we are in 2017. If you started your business in 2013 there, they can come and actually say, we want to review your business in 2013. And at that time, you have no records. So whatever demand they'll give you, how will you fight it? And you want to exercise your right to object and appeal. So you have to keep records. And the other one, obligation, be honest, yeah? So the registration obligations that are there, there's income tax, there's pay as you earn. And pay as you earn is for the employers. And what we've seen is that individuals, you're not even doing business. You're even employed, but you've even gone and registered for pay as you earn. So somebody asks you, so where are your employees? But you just didn't know and you went and registered for a wrong obligation. Then there's VAT. So we'll look at what point you have to register for VAT. And then there's custom duties if you deal with importations or exportations. Then there's the element of deregistration or dormant PIN or obligation. So in this scenario, you started business in 2015, business went well, then come 2016, something happened, the industry changed, there's no more business. But you're hopeful in subsequent years, business will pick up. So what happens, and you've registered, you've even told your employees, okay, go home, there's nothing for you to do here. You've even registered for VAT. So what happens in such a scenario? The good thing nowadays with the iTax platform, you can actually go ahead and file for dormancy. In the past, what would happen if you don't want to continue with all the obligation, you do deregistration. And when you go the angle of deregistration, you must go through an audit for the Revenue Authority to confirm that before we clear you out of the system, have you paid all your back taxes, if any? The beauty with dormancy now, with dormancy, it's going and clicking a button saying, for now, let's pause my business. And when you click the dormancy page, that means you'll not be required to do your monthly VAT returns because you filed for dormancy, meaning you're not in business for now. But it means the minute you start going back to your business, you will actually go back and reactivate your PIN so that now you can continue starting to file your return. And this is a tool that many people can use, and it saves you on money. Because at that time, if you do not file your returns just because business has gone down, that means that the obligation for filing return, especially the pay as you earn and the VAT, it's a monthly obligation. Whether you have anything to declare or not, you must file the return. And that's why the dormancy option gives you a good way out. So, overview of the taxes. So these are the different types of taxes that you have in Kenya. There's corporation tax, which will cover. There's withholding tax. This is for when you're withholding tax for consultancy services. Then there's turnover tax and VAT. The ones I've highlighted in red, there are other obligations, but we will not cover them in this forum. There's stamp duty, capital gain tax, custom and excise, and personal taxes. So, if we start with business income, corporation tax. So the first thing we ask ourselves, what income is subject to tax? And it's interesting to note that when you are looking at business, business is defined as wide. It's very wide. It's any vocation or any hobby. As long as you generate a profit, it's considered business. And one thing many people usually forget, I'm sure, the problem with Nairobi space has gone down. In the village, our parents, I'm sure they've put chicken, they have veggies, yeah, which they sell. Are they in business or not? They are in business. So, from a corporation tax perspective, they're considered in business, and ideally, they're supposed to pay taxes. But we look at how to cover those small businesses. Then there's employment or services rendered, rent, dividend and interest, and any amount deemed to be income of a person under the Income Tax Act. And that's why this is so broad, because how they're looking at it, it's very wide, meaning all forms of business are subject to almost tax, yeah? So in terms of looking at the forms of income, is there anybody in this room who feels their income should not be taxed? It's business. You're not doing business. That's a strong position, yeah? Because for her, she doesn't believe she should pay any taxes. But one thing before we continue is that, you see, it's a burden which everybody feels it should not be on my shoulder, right? Yeah? I see somebody is really strongly agreeing, yeah? It's a burden that we feel like, why, okay, what gives you the right to take a percentage of my revenue? You're not even a shareholder, you're not a business partner, but it's an obligation that is here with us. Taxes have been there from the days of the Bible. It's not going anywhere, but we have to find a way of wiggling and adjusting and try to comply. Because this is where the revenue gets, the government gets 60% of its revenue. So it's not going anywhere. So we have to find a way of surviving with it. Yeah? Unfortunately. Okay. So for corporation tax, one thing people forget, when you're looking at your business income and you're looking what is subject to tax, what happens is that many people think that as long as I have my income, I do a percentage, the 30%, and I tax it. But it's different, because what happens is that when your auditor has done the accounting and they've told you your profit is 1 million, then you have to do something called a tax computation to determine what taxes do I have to pay. And this is where now, you remember when I said about keeping records and everything? Now this is where it comes to be important, because when you're doing your tax computation, you must ensure that you can actually support all your business expenses. If it is something that is not related to generating that income for the business, from a tax perspective, you'll be told you cannot take a deduction. So now we will be looking at what are expenses you can claim to reduce your taxable income, and then we look at what are those expenses I should not be deducting to arrive at my tax. So the first one is wholly and exclusively incurred in the production of income. This generally means all the expenses I've incurred that directly relate to that income, I can claim, provided they are the ones that have been allowed. So, simple example. If I'm in the business of, I'm in consultancy. So in consultancy, the normal expenses I have is mileage, fuel, yeah? Let's say, for example, rent. Those are the normal expenses, and they're all linked to the income I generate from consultancy. So that means for me, basically, my tax computation will be easy because all the expenses I have were incurred in generating that income. So that means I get a deduction for all those expenses, yeah? The other thing we look at, there's the legal expenses on acquiring lease or premises. That means the legal fees that were there when I'm getting, let's say, my lease for the apartment that I'm using or for the office that I'm using. Those are normal business expenses, and you can actually get a deduction. Then there's something called capital allowances. For capital allowances, we look at when you have a premises, you have your furniture, yeah? You have your motor vehicle that you use in your business. What happens is that you're given a percentage of those capital assets that you have in your business for you to claim a certain deduction. And the beauty about that, it actually reduces your taxable income. And capital allowances are things that many people actually forget, because you'll be surprised how they can actually reduce your tax liability. So that these are key things for you to note. Then there's something over there called bad debts write-off. So you have a customer, you've given services, but you've been chasing, they're just giving you the response, election, 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 no money. Yeah, that's the response everybody's getting. Yeah, I'm also chasing debts, and that's what I'm getting from everyone. Election, no money, no money. I'm wondering where the money is. Yeah. So what happens is you've been chasing this person, but then they're not coming. So, and you have to write it off. So can you get a deduction for that? Because it was supposed to be ideally something that you're claiming, but now it's ended up being an expense in your books. So for those bad debts, what happens is that the commissioner has given guidelines in terms of what, like a check-off list, in terms of for you to want to claim that deduction for bad debts write-off, this is the checklist that you have to do. The number one is that you have to have shown evidence you have really, really tried to collect it. Yeah? It's where like even you've engaged debt collector to try and collect that money to prove that that person cannot pay you, and you must have evidence of that. The other thing you have to check is that the cost of collecting that debt vis-a-vis the debt I'm going to collect would not make business sense. For example, I have a client who is in the US. They owe me 500K. If I was to say I am traveling there to go collect that debt, if you count my airfare, going and engaging, let's say, an advocate on the other side to go collect for me that debt, how much will it be? Thank you. Yeah? So if you can actually prove that collecting that debt, the cost is far higher than the debt itself, then you can be allowed. Yeah? So there are commissioner guidelines, and these are some of the things, because they're very extensive, I can easily send to you, in terms of for you to be having that checklist. Yeah? Then there's expenses incurred prior to commencement of business. So you are yet to commence your business. Right now you're in the business of looking for premises, all that, but you've not yet registered that entity. But you've been claiming, you've been having these other expenses beforehand, and you're wondering, okay, what happens to the pre-incorporation expenses that have been incurring? And the beauty about that, you can actually take them as a deduction, normal business deduction, yeah? The other thing is cost of structural alteration to premises. So you have these premises, and what you need to do is maybe create a partition over there. Those partitions, normal business expenses. The only time you'll not be allowed to claim them is if you decide, you know what, let me knock down this building, put up another building. That's a new building, right? It's not alterations. So those ones, you will not be allowed. And then there's the other thing for donations up to approved organization. So we believe that people should still be philanthropic. So it's good to give, but when you give, check the organization you're giving. And what happens is that there are organizations who have exemptions. So when you actually give the donation, ask them, are you registered? Are you exempt? They'll give you the exemption certificate. If they give you that, that donation is allowed. And then something else that was introduced this year, in the sense that if you're going to give to anything that has been declared a national disaster, let's say there's floods, we have to give something, then those donations are approved. Maybe if there's, let's say, war and we have to give, supplies, those donations will be approved, as long as you channel them either through Red Cross or other approved bodies. Yeah? Then, what I said about capital allowances, that we have to be really keen, because this is an area where many people forget. Number one, there's investment deduction. For investment deduction, this is where you go when you're in a manufacturing business, you go buy a plant and you use it for manufacture. The beauty about this, you get a deduction of 150% of that plant. That means on top of the normal, if let's say it was 100 million, you're allowed to take a deduction of 150 million. That will actually reduce, in fact, you'll find that many people who deal in manufacturing and actually do this, they end up not paying any taxes for the first 3 or 4 years because of the deduction they actually get. Then there is industrial building allowance. This is a small deduction where if you have premises and you actually have a building, you get staggered deduction that you get to enjoy over the years. Then there's the wear and tear allowance. This wear and tear is a normal one where you'll find that you've classified your motor vehicles, your furniture come in there. So you're allowed to also get a deduction on the same. Then there's soft furnishing. Sort furnishing, this is the carpet, the curtains that you have. You get a deductions for that. If you're in farming, there's also farm work deductions. And for farm work deduction, it's also 100% in the first year that you made it. That means even if you're a farmer, the entire 100%, let's say if you created a cowshed structure and all that, that means that entire deduction, you get it in the first year. Then there's also mining deduction, also 100%. So these are key capital allowances that you really need to think about when you're starting your business. Then there are the things that we should avoid, things that we need to remove when we are doing our tax computation. The general one, if it does not relate to business, don't claim it, yeah? All your personal expenses, you've gone to the salon, please, don't bring that expense to the business, yeah? It's personal, let's personal remain personal. And this is where I even tell people, if you've just started your business, let's separate your personal account and your business account. Let's not mix those two cards, yeah? So that it's easy for you to do your accounting. And then capital costs, this is where you do the building. That one, it's not allowed because you've been given the deduction on the other side. And then if you've paid any taxes or penalties also, it's also not allowed as business expense. And then when it comes to pension, for pension, what happens is that for pension, there's registered bodies for pension, where you actually contribute your pension. And for pension, you've been contributing it, let's say if you're employed. Now that you're doing your own business, you can actually go to registered pension scheme and continue making your own deductions. If the pension is registered, you're going to seek for a new pension. First question you ask them, are you registered? Are you registered by RBA? And then do you have an exemption from the Revenue Authority? So that now, you know you're contributing your pension to a registered scheme. If you contribute to a scheme that is not registered, automatically that expense will not be allowed. Those premiums that you're paying will not be allowed because the scheme is unregistered. So this is also a tax planning measure where when you make sure you get services from the right providers so that they don't cost you. Then expenditure or losses that are recoverable under insurance. Liz talked about that if something goes wrong, insurance will compensate, life will continue. So what happens is that if you're going to be compensated, you've incurred a loss, something has gone wrong. If you're going to be compensated by insurance, then you're told, don't take it as your normal business deduction because it's already outside. The insurance will cover it, let it be settled outside, yeah? And then on the flip side, we had talked about donations. So if you do donations that are not to an approved charitable organization, then you'll not be allowed to take those deductions as expenses. So this is a simple illustration. I've been talking about this term disallowable, allowable. So somebody is wondering, what are allowable, disallowable? Speak in English, yeah? So in English, add less, yeah? So meaning, when I start from the accounting profit, yeah? When I said we add, that means anything I said I am disallowing, I will take your taxable profit and add it, meaning I'm increasing your taxable profit. You see, if I have those expenses that they were personal expenses, contributions to a pension scheme that's not registered, I will add it, meaning I'm going to start increasing the profit that I had, yeah? And then to less, meaning you're reducing your taxable profit, we will be lessing the things I said, capital allowances, and then other normal deductible costs, so that now I get to an adjusted taxable profit. You see, the beauty about this is that if you have less of the add and then more of the less, that means you may end up even in a loss, yeah? Yeah. So you have to make sure that you manage your capital allowances, ensure you have all your deductions as much as possible to reduce your tax liability. Yeah? So we've discovered that you have a tax liability to pay. Well, how and when do I pay it? So for corporation tax, you have to pay it in 4 installments. And they're looking at it so that it's not a heavy burden at the end of the year. When you look at it and you've just made money and maybe the money was used a long time ago. So to ensure that you stagger your obligation, you can pay your taxes in 4 installments. And what happens if it is your initial year, you can wait. If you're not sure how you will do it, you can wait till the end, then you start the business. Then alternatively, if it is your second year of business, what you do, you take your last year's tax, you up it by 10%, divide it by 4, and pay it in 4 installments. And the installments, it's the 20th of the 4th month, 6th, 9th, and 12th, depending on the year end you've selected. For year end, it's open. You can do whichever year end you want. The only people who are controlled are insurance firms and banks. So those ones are the ones they have to use the calendar year, but the others, you can pick whatever year end you want, yeah? And then if you find that you did your installments, but then there's some liability that remained, you can actually pay it in something called balance of tax. That means after you've done your books at the end of the 12th year, you've discovered there's an additional tax to be paid. You have to pay it by the 4th of the end of the financial year. And then when it comes to the tax return is due on the 6th after the end of the financial year. So we have finished corporation tax. But the corporation tax I've covered here, it's mostly for the limited liability company. But the similar concept in terms of adding disallowable and allowable, it's the same even if you're a sole proprietor. It's exactly the same. But what happens if you're a partnership, we'll get to this point of the profit, and then now we will not tax it on the partnership, but each person, based on how you've distributed your profits for the partners, then the partner will be taxed on their own at still 30%. So there's something called turnover tax. And turnover tax is something that has been there for a very, very long time, but people have just not discovered it, or they don't know about it. And this one is to cover those small businesses that are not registered. So, and then also for turnover tax, what happens is that it is there for the small businesses, as I said, and it is more easier to administer. You see, when you're looking at the limited liability, we talked about adding disallowable and all that, but for turnover tax, you'll find it is straightforward in terms of how to administer it. But it's not for everybody. As I said, it's for small businesses, and then also, if you're in the following sector, you get rental income, management and professional fees, training fees, or you are an incorporated company, or income which is subject to final withholding tax, you cannot use turnover tax. So it is for the other businesses that can be conducted apart from this one listed here. So the threshold, if your business is in the range of 0.5 million to 5 million, then this is your tax. You remember I'd spoken about our parents who are at home, they have their cows and their chicken. You see, for them, they are below 0.5 million, I'm sure, unless they are doing large-scale farming, yeah? So if you're below 0.5 even, there's no tax, sort of, because it's very small, and even the cost of administering, looking for all those small businesses wouldn't make sense. So if your threshold is between 0.5 to 5 million during any year of income, then this is your tax. And how is it? It's just simple. Just take 3% of the 5 million, and that's it. And it ends there. So this is always a good tax to administer for the sole proprietorship sort of business. And then also, in terms of return, it's also supposed to be done on a quarterly basis, 20th of the following end of the month, yeah? Then, what happens in the event that you do not have any income, yeah? If you do not have any income, you're still obligated to file a nil return, yeah? So, we go to withholding tax. So, withholding tax has always been there, but one where people don't understand in terms of how to administer it. So withholding tax is a tax that is a payment in advance, because the person you're withholding the tax from is still going to do their corporation tax, and thereafter they will get a deduction of the withholding tax that is there. So, what is withholding tax? So this is a tax on services for both residents and non-residents, because you'll find that for people who are coming from outside Kenya, they're coming to offer services in Kenya. How do we tax them? So the only way to tax them is when we do withholding tax, yeah? And then, what's the tax point? Because tax point, is it when I'm going to pay you, I'm going to withhold, or is it when I notice the expense in my books? And what you'll find is that the practice has been when you're making the payment, you do the withholding tax. And then the question of why withholding? Yeah? I think it was jammed. It was hand. Yeah, so why withholding? As I said, it's more to net everybody. Look at this scenario. I've come, rendered professional services, yeah? Then you pay me my entire fee. Hold. Then when I'm filing my return, I file a nil return. Who will know I haven't paid taxes, or who will know that I got income and did declare it? Will anybody know? But in another scenario, I offer you services, you withhold at 5%. When you withhold via iTax, when I'm going to file my return and I file a nil return, it will not go through that return, because it will recognize that there's a withholding tax element that I have to take a credit from. And when I take a credit, thank you. When I take a credit, that means I have to declare the corresponding income. So this one, it's mostly there for cash flow purposes for the Revenue Authority, because it's an advanced tax, and then also a cost-effective collection measure through the use of other taxpayers. Because what's happened is, you who's paying me, you're acting as an enforcer, enforcing me to actually declare my revenue at the end of the year. Because what used to happen in the past before we moved to iTax, I would easily go away without paying any taxes, because I've given people services and then filed a nil return. But now with this one, that means I have to declare the corresponding income. Then it's also an avenue for taxation of non-resident. As I said, it's withholding tax there. It's there for resident and non-resident. That means also for the non-resident who've come to do business, I also have to withhold when they give me services. Yeah? And then payments subject to withholding tax. There's interest, dividends, agency fees, royalty, management, professional, and training fees. Why I have to go through each of the lists is to demystify. People end up withholding on everything and anything, yeah? If anybody has given you something, even I found a scenario where somebody gave goods, but they were doing withholding tax. Not the other withholding VAT, they were doing withholding tax. Why? They're like, we don't want to be caught. But you see, you're not doing the right thing. So withhold on the following services listed there. Then there's contractual fees for building and civil and engineering works, yeah? So when it comes to whose obligation is this, the responsibility is on the person making payment. What happens with withholding tax is that if you are the one making that payment and you do not withhold, it now becomes your obligations. That means when the Revenue Authority is coming to audit you and they say, you paid Lydia for tax services, you paid her, I look like 1 million, yeah? So you paid me 1 million, but you did not withhold. So they'll tell you, since you are gracious enough to let her go, you have to pay that tax on her behalf. So that means it becomes your obligation, yeah? So when it comes to withholding, remember, these are payments subject to withholding tax. So, and this is your responsibility. You ensure you withhold and make the payment. Another thing we've seen is that people withhold, but they don't remit. They use it as their money. No, not your money. When you withhold, pay it to Revenue Authority, yeah? And then also, your obligation is to compute the withholding tax using the right taxes. The other thing is you have to remit it to the Revenue Authority by the 20th of the following day and issue a withholding tax certificate by iTax. So in terms of the rates, those are the different rates. For management fees, below 24,000, it's 5%. Contractual fees, 3%. Royalties, 5%. Interest, it's 15%. And dividends, locally and other people in EAC, it's 5%. Then we do have for non-resident rates, it's 20% mostly. Dividends at 10%. Interest, similar to resident and resident, it's both at 15%. But we do have other things, double taxation agreements, which are there to reduce liabilities. So this is something that you can actually use to reduce your tax rate, because now the rate will no longer be 20. If you have a double taxation agreement, you'll find that it goes down to 10%. So for VAT, I'll cover it simply in the sense that the number one thing that people do, I've just started business today. I go and registered for VAT obligation, no. You're only supposed to register for VAT if you reach the threshold of 5 million and above of your income. If you've not yet reached that threshold, don't register unless you're doing voluntarily. Because what happens after you register, you have to start filing the monthly return. So I'll go to just an illustration for how it's done. There's something called output tax. Output is when I'm offering the sale. When I give the sale, I charge VAT, right? Then, when I give you services, I also charge you VAT. So there's output tax when I'm making sales. Then there's input tax when you're making purchases from other people. People forget to claim their input tax, which reduces your output tax liability. Because you'll find that when you take your output, reduce your input, you'll end up paying a lower liability. If you did not have any input, that means you'll have to pay the Revenue Authority how much? 250. So this is where I say you have to ensure you keep all your records, because that's the basis of how you claim your input VAT. Yeah? We'll handle VAT because I know there'll be a number of questions for VAT in terms of the problems that you have for VAT. So, common mistakes, poor record keeping. Records, documentation is very, very important, yeah? The other thing, ticking erroneous tax obligation. You're just a sole proprietor, but you've ticked all the tax obligations, and it is not your obligation, yeah? Wrong business or having wrong structures, yeah? You're a non-for-profit or an NGO, but you've done a company limited by shares, and people think you're doing business, but in the real sense, you're an NGO. Then there's mixing business and personal expenses. I'd mentioned that. Then not deducting genuine businesses. So at the end of the year, you find that you have to pay taxes worth, let's say, 1 million. And then you're like, As some friends here feel like, no, we shouldn't be paying taxes. You decide to concoct certain expenses, which you know very well don't exist, yeah? It will catch up with you. Then late submissions of returns and of taxes. This is an area you can avoid, because why are you paying it late and you knew it's supposed to be paid? Why are you filing that return late? Because you'll find that the penalty for filing the return late, it's 10% or 5% of the tax due. Why are you incurring all that additional expenses? For what reason? Yeah? Then, wrong classifications for contractor vis-a-vis employees. Then, the other common mistake, underestimation or estimation of taxes, and then filing nil returns in order to beat deadlines. This one is where you know I have income, I need to declare something in the VAT return, but because of one or two reasons, the whole year you've been filing nil return. That's fraud, eh? It's gonna catch up with you. Then ignorance. As they say, ignorance of the law. Thank you, yeah? Then relying on unqualified professionals. This one I cannot overemphasize, because you feel like this person, no, they'll charge me a lot. You go to somebody who just says, yes, I can do taxes, but they don't know the beginning to the end. So ask them questions, ask them how long they've been doing this, find out, tell them, give me testimonials from your client, something of that, to just check if they know what they're talking about. And then not asking for professional help when you know you're in the thick of things, yeah? And then there's something called bribing, yeah? This is a Kenyan problem. We bribe today, we think it's over. Is it really over? Thank you, yeah? Let's not bribe, because once you start, you'll continue bribing till the end, yeah? And then take away, comply, 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 register for the right taxes, file returns on time, pay taxes on time, understand what obligation or what taxes I need to pay, maintain proper tax and accounting records, and when in doubt, engage an advisor, or when in doubt also, call KRA. They'll help you, maybe. I don't know, but yeah, but they do help. And then, if you think compliance is expensive, try non-compliance, yeah? Thank you.